Tom and Jack, co-shareholders in their company Titanic, were keen to purchase a Thai food franchise. However, the company did not have the necessary funds, and as a result had to borrow 1 million rand from a bank to purchase the franchise. The bank required Tom and Jack to stand surety for the debt owed by the company, and the shareholders duly signed what the bank described as the standard agreement. The pair purchased and operated the franchise store. Tom was a hands-on manager who managed the day-to-day activities of the business, including overseeing the staff. Jack played a more strategic role, focusing on marketing and overseeing the finances. One day Jack was saddened to hear that Tom had died in a tragic accident. Since Tom was a key person in the business, the bank began to doubt whether the company could continue to meet its commitments in terms of the loan without Tom at the helm. As a result, the bank decided to call in the debt. As the company was not in a position to pay the outstanding loan, the bank decided to claim the full outstanding amount of 1 million rand from Tom's estate. Tom's wife was devastated to learn from his executor that by standing surety, Tom was liable as a co-principal debtor. This meant that the bank could claim the full amount from his deceased estate without having to first claim from the company. By standing surety, Tom was jointly and severally liable. The bank could therefore claim the full amount from his deceased estate without having to claim anything from Jack. Tom's suretyship was unlimited. As Tom held a 50% share in the business, he should have negotiated with the bank to limit his liability to 50% of the debt. Tom did not have sufficient cash in his estate to pay the claim, and his only asset, the family home, would have to be sold to pay the debt. Tom's wife and the children would therefore have to find alternative accommodation. These unfortunate consequences could have been avoided with a contingent liability arrangement. Tom's executor proceeded to explain how this arrangement could have been implemented. The company could have owned and paid the premiums on policies of insurance on their lives, which could have been paid out to the company on the death or disability of either of the shareholders. Tom and Jack would then have entered into a written contingent liability agreement with the company, obligating the company to use the policy proceeds received for the sole purpose of paying the debt owed to the bank. As the debt would be eliminated on the death or disability of a shareholder, the individual estates of the shareholders, and consequently their families, would have been protected. For more information about contingent liability insurance, please speak to your Sanlam advisor or accredited broker. This Financial Solutions for Business Owners Contingent Liability podcast was brought to you by Sanlam.